So we can do the gift, we can do partial interests, we could sell the house to the trust, take back a note, take back liquid assets. Maybe we have a dynasty trust out there that's already got liquid assets, and I'd like to transfer assets from, I'd like to get some liquidity back. Here, kids, you can have the vacation home, you pay me the liquid assets, and it's an even trade, and I now have the liquidity that I was looking for, and you now have the house that I just stuck you with. And if it's sold for a note, then obviously you need to think through how we're going to service the note. Does the trust have cash? Are we going to lease it back? Is that going to service the note? Maybe they're leasing it to third parties as well, so there's rental income, or the usage fees, or what have you. Another method, of course, is the Cupert, which I won't go into a huge amount of detail, but so the Cupert, as you know, transfer the house. It's in 2702. Retain an interest in the right to use the house for 5 years, 10 years, 20 years. At the end of the term, it goes to the kids. 2702 says the gift is the value of the house minus the value of my retained interest. So because I've retained interest for 10, 12, 15 years, the gift is a smaller amount. And just a quick example, $2 million house, 10-year Cupert, so they get at the end of 10 years, 2.8% rate. So I've lowered my rate now. And a person age 60, because if you die before the term, trust ends, comes back to my estate, which actually helps lower the gift. So under those facts, the $2 million house, the gift would be $1.3 million. So a $700,000 quote discount, which is not bad at all. So 35%. If the house, so these this discount, the benefit of the Cupert depends on the rate, the term, the age. So if we took all those factors and changed them, so we had 10 years, 2.8%, age 60. If we go to 15 years, age 70, and 5%, so we upped everything. Then the $2 million house, the gift, would be $443,000. So it's about a 75% discount now off of the current value of the house. So you go longer, you have an older person, or you have a higher rate. $2 million house, the gift could be $1.3 million in one example, could be $443,000 in the other example. So it's a function of all these factors. And the risk is you go too long and then the grantor didn't survive and it's back in their estate. So you have to play with those numbers. Interestingly, someone, even a very elderly client, might benefit from a Cupert, even with this survival requirement. Let's take a 90-year-old and we do a 3-year Cupert. You might say, wait, a 3-year Cupert? I mean, how much discount are you going to get? It's only for 3 years. But the gift is only if they survive the term and if they live 3 years and survive. Well, according to the IRS tables, a 90-year-old probability of surviving 3 years isn't huge. And so there's a decent probability the remainderman will never get that. And so if we do a 90-year-old, $2 million, 3-year term, 2.8% rate, the gift is $1 million. It's 50%. I was surprised by this myself. This is the same as if a 60-year-old did a 13-year Cupert. A 90-year-old can do a 3-year Cupert with the same gift. I actually had a 90-year-old do a Cupert. For some reason, we decided, well, let's check the numbers. Ha, ha, ha. It's never going to work. And we ended up doing 2 Cuperts. We did a 2-year and a 3-year. So if she survived 2 years but not 3, half was out of the estate. If she survived 3 years, then it was all out of the estate. And fortunately, she survived all 3 and then some. So they both worked, but it reduced the risk, and it was a pretty big discount to our surprise because of this factor that the age reduces the value of the gift. So I wouldn't write them off because a short Cupert can actually make a big difference. So the Cupert assets basically have to consist of a home or a second home. You can only have 2 Cuperts running at the same time. You can't have 3, or unless actually you can have 3. So I could have half my primary residence in one Cupert, half my primary residence in another, say a 10-year and a 15-year. So that's one house. And I could have another house and another Cupert. So I could have Cuperts with 2 homes at one time. Can't have Cuperts with 3 homes. But when one finishes, then I can do keep going down the list of all my various homes. It can hold cash only to cover expenses for the next 6 months, 6 months going out. You have to have a clause in your Cupert that says the house cannot be sold to the grantor, to the grantor's spouse, or to a grantor trust as to either of them, during the Cupert term, or after the Cupert term if it's held by a grantor trust. What they're trying to do is say, guess what? When this thing's over, or when the person's in poor health, you can't buy this out without triggering gain, so you can't buy it from a grantor trust, get it back in your estate and get a basis step up. And that's something to keep in mind. You need to have that in your other trusts. So I often have my Cuperts. I'd like to avoid creating yet another trust in the world. So, and they already have their insurance trust or something else over here. So wouldn't it be nice if I can create a Cupert several years later and say, and when it's done, it'll pour into this same trust. And maybe that has other assets as well to maintain the house. So what I'm doing as a matter of course is in all of my irrevocable trusts, whether it's for annual exclusion gifts or lifetime gifts or life insurance, what have you, I'm just throwing in this clause in the back saying, by the way, if property ever comes to this trust from a Cupert, and this trust is still a grantor trust, it cannot be sold to the grantor and grantor spouse and so forth. If you don't have that, you can't add it to that trust. It would violate the Cupert rules in the first place. A Cupert ceases to be a Cupert if the house is sold or destroyed and the proceeds not reinvested in a new house within 2 years. And then it has to either convert to an annuity trust or pay the assets out. We have the usual issues: continued use following the Cupert term, make the spouse a beneficiary of the trust afterwards, lease it back. So then there's also joint purchase Cuperts. So there's been several rulings, actually dating back to 1998, several in 2007, 8, 9. I think I stopped tracking them after that, where the biggest issue with the Cupert for a lot of clients is, I want to use that, I want to give it away, I want to use it for my lifetime, I don't want to pay rent, and that's that. So what can you do for me? A joint purchase Cupert was intended, or is intended, to address that. In these cases, in these rulings, what happened was, and there's two variations. In the first one, we had husband, wife, and son. And they all came to the table one day and said, let's put money into a trust. And by the way, this trust is going to look and smell like a Cupert. The trust is going to say, let's put money in this trust, and this trust is going to turn around and buy a house, that one that we're looking at down the street. And the trust said, husband and wife have the right to use the house for their lifetimes, and at the end of both of their joint lives, it will go to the son. And they looked at the IRS tables and said, okay, use of this house, of this property for their lifetimes at today's rate and their ages was X dollars. So their interest is worth X dollars. Son's interest is worth Y dollars. So son contributed Y dollars. They contributed X dollars to the trust, so they paid for their interests. The trust bought the house, and they asked the IRS, so did this work? And they said, yes, there's no gift made because everyone paid their proportionate amount. This trust qualifies under 2702 as a Cupert, so there's no deemed gift under 2702. The trust won't be included in husbands and wives' gross estates under 2033 because their interest terminated at death. Now, the one thing that they wouldn't say in these rulings is they explicitly refused to address whether 2036 would apply. We'll turn back to that in a minute. But what they had was IRS blessing, at least on the gift tax aspects, of a lifetime Cupert. We can just live here for life. Our gift is done. Son paid us for it. We put the $2 million house in. We bought a $2 million house. Maybe he paid $300,000 for his share, and one day he'll get it. And we don't have it end. We don't have to rent it back, and we can pay all the maintenance anyway as the life tenants. There was a second version in some of these rulings where they already own the house. So husband and wife put their existing house in the Cupert. They did the math and figured out son's interest was worth X dollars, and he paid them for it. So two variations on the same thing. The results were the same. There's no deemed gift. This qualifies as a Cupert. Everyone was happy. So they didn't address 2036, which I love when they do that. We'll tell you everything but what you really want to know. And we'll take your private letter ruling fee. They refused to adjust 2036, but I don't think 2036 would apply, and maybe they didn't want to tell you that. In fact, you would think if their opinion was that 2036 would apply, they would have said so and put a chill on the whole thing. The reason I don't think 2036 applies is twofold. One, there's no transfer with the retained interest. In the case where they put cash in, everyone put cash in and then they bought the house, they didn't transfer the house. Everyone came together. It was like a joint trust. I'll put this in, you put that in. I bought my life interest. I bought my remainder interest. No one transferred anything to anyone. There's no transfer with the retained interest. They each bought their interest. So 2036 looks like it can't apply. And in fact, they said there was no gift because everyone paid the right amount. Well, if there's no gift, how can there be a transfer with the retained interest? If there's no gift, then you would think the bona fide sale exception under 2036 by definition applies. So I think they'd have an uphill battle on 2036, but I am still a little nervous. I'd like to see that first case come out about that. So when if I was to do one of these for a client, I'd tell them there is some risk here. And we don't know what the answer will be. So a couple other points in Cuperts. The idea of multiple Cuperts I mentioned. You can do it for valuation discounts, but you can also do it to reduce the risk. So I want to do a 15-year Cupert, but what if I die in year 12? Maybe I'll hedge my bets a little bit. I'll do a 12-year and a 15-year. So if I survive one and not the other. Or maybe I'll hedge my bets even more, and I'll put half into a Cupert, my wife will put half into a Cupert, and if one of us survives and we got half out and we both survive, we get it all out. So we diversified in terms of time or both of our lives. Another method for transferring a house. So I'm actually now going to go back to the RPM trust. I mentioned earlier the RPM income trust can be a substitute for a Cupert. So let's go back to the RPM income trust. I put the $5 million in the trust, or actually my first example is $4.5 million. The Dynasty Trust paid me $2 million. My wife has the right to the income from the property. Actually, what it'll say is she has the right to use the property or the income. And the 7520 tables say the income tables are for the right to use or get the income from property. So use/income, same table. And that's why we use that table for valuing Cuperts as well, the income table. So we have the $4.5 million in here. Now what do? I sell my house for $2 million to the trust. So the trust has $4.5 million, pays me $2 million, still has $2.5 million left, can maintain the house, pay the income to my wife. It now has the house in there. My wife's a beneficiary, so I can stay there with her. And why is that better than a Cupert? All the reasons that we talked about for an RPM trust. So first of all, we don't have the mortality risk. If I die, 2036 can't apply. If my wife dies, 2036 doesn't apply. She didn't transfer anything to the trust. It's now in a GST exempt trust. Cuperts can't be GST exempt. Now maybe we can make it comfortably for 25 years, or maybe even just make it for my wife's life, period. 2036 can't apply. We have this joint purchase Cupert rulings, but they didn't give us a definitive answer on 2036. We don't have all the rules with a Cupert. If the house is sold 5 years into the RPM trust, it's not a Cupert. It doesn't say it has to convert to an annuity or anything. The house is sold. They buy another house. They buy stocks and bonds. It's not a Cupert. It's just an income trust. It happened to buy a house. It happened to sell the house. But the Cupert rule saying you got to buy a new house in 2 years or the thing converts doesn't apply. You can have houses or properties in this RPM trust that wouldn't qualify to go into a Cupert. A Cupert has to have a personal residence. And there's a whole bunch of letter rulings where people say, well, does this one qualify? Because we got a personal residence, but we also have 4,000 acres behind it. Can we stick that in there too? Well, if that's what the neighborhood is like, then you can, is generally the answer. But I don't think 4,000 acres. But so at a Cupert, you can really just transfer a personal residence, whether you can transfer other types of property, a farm, a ranch, a vacant lot. Those aren't going to qualify to go in a Cupert. An RPM trust is not a Cupert, does not have the rules. You take the $4.5 million, you buy the farm or the ranch. Whatever income it generates goes to the spouse. You sell the farm or the ranch, the trust has the money. It just works like a, quote, normal trust that pays the income out, but we don't have all the rules. So different types of property, doesn't prohibit sale. We don't have to have that clause in an RPM trust that says, by the way, you can't sell the house back to the grantor or grantor's spouse. So you can buy it back and get a basis step up prior to death. Trustee can add more. You can add more money to an RPM trust later on. There's gift consequences for it, but you can't add anything after the fact. Well, actually, I guess there's gift as well. So the RPM trust is a Cupert substitute. It's really ideal. It solves all those issues. You get rid of all the inflexibility that you might have in a Cupert. You don't have the mortality risk. You've got the GST benefit as well. The one big caveat, again, is the house belongs to the spouse, and you cannot have a divorce clause. So if you take your primary residence and put it in this RPM trust, and then your spouse says, thank you, here's my divorce papers, he or she is going to continue having the use of that house for the rest of their lives or until the whatever term is. You can't have a divorce clause. As we mentioned, you can live with the spouse. One last point on transferring homes is watch out for local transfer taxes. Depending where the house is, always consult local counsel, probably are anyway if there's a deed out of state or whatnot. But I've had many jurisdictions where they say, if you're transferring it for no consideration or if it's just family, there's no transfer taxes. But I've had other areas where there's a transfer tax on almost anything you do. You just don't want to have a surprise to the client. Oh, we found out after the fact that there's a 1% tax on the value of your home, and you owe $20 or $50 or $100,000 to the local village. They just won't be happy if they learn that after the fact. So, any questions on transferring homes, and then we'll take a little bit of break before the next one. All good. So it is a little before 10 after. So why don't we about a 10-minute break? So 20 after or so. We'll resume. Thanks.